Welcome back to the Deep Dive, where we try to transform complex information into, well, clear, actionable insights just for you.
Mhm.
Today, we're doing something maybe a little different, definitely practical, though. We're turning our attention to the fascinating world of California real estate.
Yeah, fascinating and sometimes tricky.
Exactly. Specifically, those, tricky concepts, the ones that often become stumbling blocks when you're prepping for those crucial exams.
Right.
We know you've been hitting the books, the study guide, the practice tests, and we've really tried to pinpoint exactly where those nuances lie.
Yeah, we've looked at where people tend to get tripped up.
Our goal is to clarify those specific questions and concepts that might have, well, giving you some trouble. Think of this as your personalized audio study guide, really designed to solidify your understanding.
That's precisely right. We've taken a deep dive into the common challenge areas, drawing insights, directly from practice test results and frequently asked questions. Our mission today isn't just about handing you the right answers. It's really about helping you understand the why behind them.
The context.
Exactly, the deeper context. That's what truly cements your knowledge,
Mhm.
right? Turning those moments into genuine aha revelations.
Yeah.
So if you've ever felt a particular real estate concept was just beyond your grasp, or maybe you're looking to really lock down your understanding before taking that big leap, the exam, or into your career, this deep dive is specifically for you.
Okay, let's unpack one of the, fundamental areas, but also one that seems to cause a lot of confusion. Agency.
Absolutely core stuff.
It really is. Crucial for anyone in the field, but like you said, sometimes the lines around who can do what they get blurry. Especially when we start talking about the authority to bind.
That phrase comes up a lot.
It does. What does that really mean in a practical sense? And, which types of agents actually have that power?
Yeah, that's a fantastic place to start because you're right. The concept of authority to bind is definitely a frequent point of confusion, and for good reason. It's complex.
Okay.
So when we refer to an agent having the authority to bind their principal, we're talking about their legal power, their ability to obligate their principal to a contract or an agreement, or even just a specific course of action.
So their signature counts as the principal's signature, basically, within limits.
Within the defined scope of their authority, yes.
Yeah.
Their signature or their actions can legally commit the principal. It's a heavy responsibility.
I bet.
So let's break down the different types of agency and look at their levels of this binding authority. It varies quite a bit.
Okay.
First up, we have special agency. Now, this is by far the most common type you'll find between, say, a real estate agent and their client. Seller or buyer, doesn't matter.
Right, the typical listing or buyer representation.
Exactly. A special agent gets very limited authority. Their role is really confined to performing a specific act or handling a single transaction. Like a listing agent is hired to find a buyer for the seller's property. That's the mission. They can market the property, sure, facilitate showings, bring in offers, even negotiate terms for the seller. But, and this is the absolutely critical distinction, a special agent does not have the authority to bind their principal, the seller, to a purchase contract.
Oh, okay. They can't just sign the deal for the seller.
Nope. Can't do it. The agent can't just sign the sales agreement on the seller's behalf and legally force them to sell. The seller has to personally review it, agree to it, and sign the listing agreement initially, and then ultimately the purchase contract to make it binding.
So the agent's a facilitator, a negotiator?
Precisely. But the final binding decision and the signature, that rests with the principal. Overstepping that limited authority, well, that can lead to serious legal trouble for the agent.
Makes sense. What's next? General agency.
All right, general agency. This type grants broader authority than special agency. It allows the agent to act for the principal in a specific business context or, a defined range of ongoing matters.
Okay, like more than just one deal.
Exactly. A prime example, one you'll see constantly in real estate, is the relationship between a broker and their sponsored sales agent.
Ah, okay. The agent working for the broker.
Yes. The sales agent acts as a general agent for their broker. This means the sales agent does have the authority to bind their broker to certain contractual obligations, but only within the scope of their defined responsibilities.
Like signing a listing agreement on behalf of the brokerage.
Precisely. That's a classic example. They can bind their broker to that listing agreement with a seller client. Another common one is a property manager. They act as a general agent for the property owner. They have the authority to bind the owner to lease agreements with tenants, handle repairs, manage the day-to-day stuff. The scope is clearly defined, but within that scope, they do have significant binding power.
Got it. broader, ongoing responsibilities.
That's the idea. And finally, there's universal agency.
Okay.
This is the broadest, the most comprehensive form. It grants the agent the power to act for the principal in, well, pretty much all matters,
Hmm.
across almost all aspects of their affairs.
Wow, like a full power of attorney.
Exactly.
Yeah.
That's usually where you see it. It's extremely rare in typical real estate practice, day-to-day stuff. But a universal agent holds comprehensive binding authority in almost any situation.
Okay.
So understanding these distinctions, special, general, and universal, is absolutely critical because the consequences of an agent's actions, and maybe more importantly, who is legally bound by those actions, depends entirely on the specific type of agency relationship. It defines the limits and the breadth of that agent's power.
That distinction really does clarify things. So, okay, a sales agent acting as a general agent can bind their broker to a listing.
Correct.
But that same sales agent, when they're acting as a special agent for their seller client, cannot bind the seller to the purchase contract.
You got it. That's the core difference in authority.
The nuances around liability there must be, well, really important to understand.
Immense.
Okay, speaking of relationships and boundaries, what exactly is single agency? And why is understanding its boundaries so crucial, especially when we talk about the dangers of something called undisclosed dual agency?
Right. Good transition. Single agency is an agency arrangement where one agent, or maybe more accurately, one brokerage represents only one party in a specific transaction.
Just the buyer or just the seller?
Exactly. Either the buyer or the seller, not both. It's sometimes called exclusive agency. The core idea here is undivided loyalty. The agent owes all those fiduciary duties we talk about solely to that one principal. Now, here's a crucial point, one that often trips people up. Agency relationships are actually created at the broker level.
Okay, not just between the agent and the client.
Not solely. It means if broker Bob enters into a single agency agreement with, say, a seller client, then all the licensees sponsored by Bob's brokerage, every single sales agent, every associate broker working under Bob, they all represent the interests of that one seller exclusively in that particular transaction.
Wow, okay, so anyone from Bob's brokerage is on the seller's side in that deal.
Correct. They absolutely cannot represent the buyer in the same transaction. That would immediately create a conflict of interest, which single agency is designed to prevent. It's about full advocacy for one side.
Okay, so that leads into the danger zone, undisclosed dual agency. What's that about?
That's where things get really problematic.
Yeah.
Undisclosed dual agency is a situation where the same broker, or maybe two different agents from the same brokerage, end up representing both the buyer and the seller in a single transaction without both parties knowing about it and giving their informed written consent.
So they haven't agreed to it.
Exactly. And this is a huge violation, a significant, severe violation of agency law. It carries massive ethical and legal repercussions, potential loss of license, big fines, lawsuits, you name it.
Why is it so bad?
Because it creates an inherent conflict of interest. Think about it. How can an agent fully advocate for the best interests of both parties at the same time? Especially when their interests are often, well, diametrically opposed, like on price or repairs or contingencies.
Yeah, you can't really push for the highest price for the seller and the lowest price for the buyer simultaneously.
Precisely. You just can't serve two masters equally in that situation. So transparency, full disclosure, and getting explicit written consent from both the buyer and the seller are absolutely paramount to avoid this dangerous situation.
Yeah.
If that disclosure isn't made or consent isn't obtained, it's flat out illegal.
So even if the agents involved think they're being fair, if that dual agency isn't explicitly disclosed and agreed to by everyone, big problem, huge risk.
Massive problem. Massive risk.
Okay, now let's pivot slightly to something that seems maybe simpler but actually carries hidden legal weight. Gratuitous agency. What about just, helping out a friend or family member for free? Seems straightforward, right? But there's a hidden layer of responsibility there, isn't there? Especially for the sponsoring broker.
You're absolutely right to bring up gratuitous agency. It's a concept that, frequently catches people off guard. It's a really common misconception to think, oh, I'm not getting paid, so the usual rules don't apply.
All right, like it's just a favor.
Exactly. But in California real estate, that couldn't be further from the truth. Even when no money changes hands, even if you're just helping out your cousin find a house, a licensee, and here's the critical part, their sponsoring broker, is still held to all the duties and responsibilities of a full agency relationship.
All the fiduciary duties. Loyalty, disclosure, care.
All of them. Obedience, loyalty, disclosure, confidentiality, accounting, and reasonable care. The whole package. So, for example, if you, as a licensed agent, help your buddy buy a condo and you forget to advise them about a really important inspection contingency, even if you weren't paid a dime, you're still potentially liable for that negligence.
Wow.
And here's the key takeaway, and it's a huge one for brokers. The sponsoring broker can be exposed to significant liability if their sponsored licensee messes up in a gratuitous agency situation, just as much as if it were a full commission-based deal.
So the DRE, the Department of Real Estate, doesn't care if you got paid or not.
Nope. They view any action performed under the authority of that license as a professional action, regardless of compensation. And this is precisely why it's absolutely essential for licensees to inform their broker about everything and follow all brokerage procedures for all agency activities, even the favors.
Yeah.
Don't assume a handshake deal with no money means no legal obligations. The DRE and the courts definitely see it differently, and so should every licensed professional.
That's a really crucial point. I bet a lot of people overlook that. It just underscores the professional responsibility that comes with holding that license itself.
It really does.
Okay, so understanding when an agency relationship starts and when it ends is just as vital as knowing its type, right? There are very specific triggers, and some seem less obvious than others.
Absolutely. Knowing the life cycle of that agency relationship is, vital for compliance and just avoiding legal headaches.
Yeah.
Let's start with the official beginning. Pinpointing first substantive contact.
Okay. When does that happen?
This is the critical moment when agency disclosure is required by law. It generally occurs at the first face-to-face meeting with a potential customer or client. But the key is before any confidential information is shared or before you start taking any action for them regarding a specific property.
So it's not just when you first show them a house.
Not necessarily. That's a common misconception.
Yeah.
It's really about the very first meaningful discussion that could potentially lead to an agency relationship forming.
Okay, give me an example.
Sure. Let's say a potential buyer, Sarah, sits down with a new agent for the very first time. They start talking about her needs, her budget, maybe her financial situation, what she's looking for in a home.
Even before they've picked out a specific house.
Exactly. Even before a specific property is identified or an offer is even thought about. If you're discussing confidential information or starting to act in a way that implies an agency relationship exists, bam, that's first substantive contact. The agency disclosure form must be presented right then and there.
Wow. Okay, so it emphasizes early, upfront disclosure.
Totally. It's all about transparency from the get-go, protecting everyone involved. Now, let's talk about the ending. Differentiating agency termination causes.
How does an agency relationship end?
Well, agency agreements can be terminated in various ways, but they generally fall into two main buckets: operation of law and acts of the parties. And understanding the difference is really important because the legal consequences can be quite different.
Okay, let's start with operation of law. What does that mean?
Operation of law means the contract termination happens because of how the law applies to the situation, kind of automatically, without any direct action or desire from the parties involved. These are events that legally make the agency agreement void, often because it's impossible or illogical to continue.
Like what?
Classic examples include the destruction of the property. If you're listing a house and it, say, burns down or gets destroyed in a flood, like in Joey's case from the study material,
Right.
the agency agreement is legally terminated. There's literally no property left to sell.
Makes sense. What else?
Condemnation. That's when the government seizes private property for public use through eminent domain.
Right.
If a property under a listing agreement gets condemned, the agreement is terminated by operation of law because the seller, the principal, no longer owns it.
Okay.
Also, the loss of a broker's license or the death or incapacity of either the principal or the broker. If a broker's license gets revoked or suspended, all agency relationships under that broker just evaporate, legally speaking.
Because they can't legally act as an agent anymore.
Exactly. The legal capacity is gone. So these events void the agreement because the very basis or the legality or just the simple feasibility of the contract has fundamentally changed due to these external legal principles.
Got it. So what's the other category? Acts of the parties.
Right. Acts of the parties means the contract termination happens directly because of the actions or the stated intent of at least one of the people involved in the agreement. These are choices made by the parties themselves.
Like deciding to end it early.
Exactly. Examples include mutual agreement. Both sides just agree, hey, let's end this early. Like in the Saba and Liam example, they agreed to terminate the listing before it expired.
Okay.
Revocation. This is when the principal fires the agent. Maybe Peter lost trust in his broker, like in that scenario, and terminated the agreement. That's revocation.
And the agent can quit too, right?
Yes, that's renunciation. That's when the agent basically abandons or withdraws from representing the principal. Then there's the good kind of termination, completion of the purpose. The house sells and closes, or the buyer successfully buys a home, the job is done.
Right.
Or simply the expiration of the term. The agreement just runs out on the date specified in the contract.
Okay, so understanding these distinctions, operation of law versus acts of the parties is key because the legal fallout might be different.
Precisely. For instance, if a client just revokes an agreement without a good legal reason, they might still owe the agent a commission or face other contractual liabilities, depending on the agreement terms. How it ends matters.
So the destruction of the property is operation of law beyond control. But a client firing their agent is an act of the parties, a direct choice.
Got it. That distinction is really key.
Mm-hmm.
And speaking of parties involved, in a cooperative sale, where you have a listing agent working with a buyer's agent from a different brokerage who actually gets the final say in how those cooperating agents function in the transaction.
Mm-hmm.
Is it the listing agent? Another important detail that ties back into agency. In a cooperative sale, where the listing broker has offered compensation to other brokers if they book a qualified buyer, it's ultimately the seller.
The seller, not the listing broker.
Nope, it's the seller, the principal, who has the final say on what roles a cooperating agent can play. Meaning, the seller decides whether to allow cooperative agents to act as subagents, representing the seller indirectly, broker's agents, or buyer's agents, representing only the buyer.
Why does the seller have the ultimate control?
Because it's their property, their transaction, and they are the principal in that core listing agreement. Their explicit consent is needed for these roles to be defined and for how any offered compensation might be shared.
Okay.
For instance, if the seller tells their listing agent, I do not want any subagents, then any buyer's agents working on that listing cannot operate as subagents of the seller. They'd typically be buyer's agents.
So it reinforces the seller's control and clarifies the loyalty lines.
Exactly.
Yeah.
It ensures that the chain of agency and who owes loyalty to whom is crystal clear right from the start of any cooperation.
Okay, let's pivot now. Let's talk about property ownership itself. It's definitely not just about, who holds the deed. It's also about what happens when an owner passes away or how multiple people can actually share a single property. There are layers here that can get surprisingly complex.
Oh, indeed. Property ownership can be far more intricate than just having your name on a deed, especially when you start thinking about succession or shared interests or what happens when things go wrong.
Right.
A common scenario that often causes confusion, for example, is what happens when someone dies without a valid will. The legal term for that is dying intestate.
Intestate. Okay. What happens then? Does the property just go to the state?
Not usually, no. If someone dies intestate, their property doesn't just vanish and it doesn't automatically escheat, which means revert to the state, unless there are absolutely no identifiable legal heirs found. Zero. Nada.
Okay, so usually goes to family.
Yes. Instead, their property is distributed among their legal heirs by law. Each state, including California, has specific intestacy statutes, laws that dictate who inherits in what order.
It's a hierarchy.
Exactly. It's designed to ensure that the deceased person's assets are transferred in an orderly way to their closest relatives, typically a spouse first, then children, then parents, siblings, and so on, according to that predetermined hierarchy.
So it's like a built-in will provided by the state.
In a way, yes. It's a legal framework that serves as a vital safety net. It ensures property gets transferred properly and prevents assets from becoming unclaimed or tied up in legal limbo forever, even when the deceased didn't leave explicit instructions. So if Quinn, a husband and father, dies intestate, his property gets legally distributed among his heirs as California law defines. It's a structured legal process.
That's a good safety net for sure. Ensures assets find their way to the rightful heirs. But what about when multiple people own a property together? That seems really common.
Extremely common.
But it's definitely not always a simple 50-50 split, is it? How do the different co-ownership structures affect really crucial things like inheritance rights or the size of each person's share or even just their ability to use the property day to day?
Yeah, this is fundamental stuff in real estate because co-ownership happens all the time. Married couples, business partners, friends, buying an investment property together, you name it. And you're right, the implications for inheritance, share size, control, they are vastly different depending on the specific co-ownership structure they choose.
Okay, so what are the main types?
Let's start with tenancy in common. This is a very, very popular form of co-ownership. Here, individuals hold an undivided interest in the property.
Undivided interest. What does that actually mean? Does it mean equal shares?
No, not necessarily equal shares. That's where the confusion often lies. Undivided interest simply means that each owner has the right to use and possess the entire property, regardless of their specific ownership share percentage.
Okay, so if I own 10% and you own 90%.
You still get to use the whole house, just like I do. Your 10% isn't confined to, like, one small room. It's a 10% interest in the whole thing. Like in Jeremy's vacation home example with his friends, even if he only owned 8%, he could still use the entire home.
Got it. Access to the whole property.
Exactly. And crucially, in a tenancy in common, ownership portions can be unequal. One person might own 60%, another 20%, a third 20%. That's perfectly fine. And maybe most importantly, it includes rights of inheritance. Meaning, if a tenant in common dies, their share passes to their legal heirs or the beneficiaries named in their will. It does not automatically go to the other co-owners.
Ah, okay, so it becomes part of their estate.
Exactly. There is no right of survivorship here. That's the key difference compared to the other main type.
Which is?
Joint tenancy. Now let's contrast that sharply. Joint tenancy is very distinct. First, it requires equal shares among all the co-owners. No 60-40 splits allowed here.
Always equal shares.
Always equal shares. And most notably, it includes the right of survivorship. This is the defining feature.
Right of survivorship. What does that mean in practice?
It means, upon the death of one joint tenant, their share automatically and immediately passes directly to the surviving joint tenants. It bypasses probate court, it bypasses the deceased person's will, and their heirs altogether.
Wow. So it just transfers straight to the other owners on the title?
Instantly and automatically by operation of law. This could be a huge advantage for estate planning if that's the goal, but you absolutely need to understand the implication. Your share will not go to your kids or other heirs if you die first. It goes to the other joint tenants.
Okay. And you mentioned something about unities needed for joint tenancy.
Yes, to create a valid joint tenancy, 4 specific conditions, often called the 4 unities, must be present when the ownership is created. People often remember them with the acronym PITT.
PITT.
P is for possession. All joint tenants must have an equal right to possess and use the entire property. Just like tenancy in common, it's an undivided interest in terms of physical possession.
Got it. I is for
Interest. All joint tenants must hold an equal ownership share. Has to be 50-50 for 2 owners, 33.3% each for 3, and so on. Equal interest.
T.
First T is for time. All joint tenants must acquire their interest at the exact same time. If one person buys their share a year later, it generally can't be joint tenancy. It might default to tenancy in common.
And the last T?
Last T is for title. All joint tenants must acquire their interest through the same document, usually the same deed. If one person's name is added later via a separate deed, that unity could be broken.
So all 4, possession, interest, time, title, must be there from the start.
Correct. And if any of those 4 unities are broken after the joint tenancy is established, maybe one joint tenant sells their share to someone else, the joint tenancy is automatically severed, at least for that share, and it typically converts into a tenancy in common for all the owners.
Okay, so the type of co-ownership you choose.
Yeah.
It really matters.
Oh, absolutely. It has truly significant implications for estate planning, for control over the property, for how you can sell or mortgage your share, and for the future disposition of the property. If you want your share to go to your kids, tenancy in common is usually the way. Want it to automatically transfer to the other owners without probate? Joint tenancy might be better. It's a decision with really long-term consequences.
So understanding that undivided interest just means equal right to use the whole place, not equal ownership percentage.
Right.
And that right of survivorship is what really sets joint tenancy apart. That clarifies so much. Okay, now let's shift gears again. Let's talk property value. How do we actually figure out what a property is worth, and what are the crucial tools and calculations involved here? Because I hear people use appraisal and CMA almost interchangeably, but they're absolutely not the same thing, are they?
No, you're hitting on a very, very common point of confusion there. And clarifying the difference between an appraisal and a comparative market analysis, CMA, is vital for anyone in this business. No, they're absolutely not interchangeable. Recognizing their distinct purposes and frankly, their different levels of reliability is crucial.
Okay, so what's the difference? Let's start with appraisal.
An appraisal is a formal, detailed, and generally much more reliable valuation. It's performed by a state-licensed or certified appraiser.
So a specialist.
A specialist,
Yeah.
exactly. These professionals have to adhere to strict national standards, like USPAP, the Uniform Standards of Professional Appraisal Practice. They use specific established methodologies like the sales comparison approach, the cost approach, the income capitalization approach, depending on the property type.
Right.
Their reports are designed to be unbiased opinions of value, and they're often legally required by lenders for financing.
Why do lenders require them?
Because it provides an independent assessment of the property's market value. It helps protect the lender's investment by making sure the property is actually worth the amount they're lending against it. It's a professional, objective, third-party assessment used for lending, sometimes tax assessments, or even legal disputes.
Okay, formal, reliable, often required. What about a CMA then?
A comparative market analysis, CMA, is, well, it's less formal. It's certainly less detailed. It's prepared by a real estate agent, not a licensed appraiser.
Okay.
Its main purpose is usually to estimate a property's likely market value, to help a seller figure out a realistic listing price, or maybe to help a buyer decide what offer to make.
So it's more of a strategic tool for the agent and client.
Exactly. It provides valuable insights, don't get me wrong. It's based on recent comparable sales,
Right.
what's currently listed, maybe what failed to sell in the immediate area. But it's generally considered less reliable than a full appraisal, because ultimately it represents the agent's informed opinion, not a certified valuation following strict U.S. Poppy Guide guidelines. It's a tool for agents to advise their clients and guide strategy, definitely not a substitute for a lender's required appraisal.
Got it. So CMA guide strategy, appraisal satisfies the lender. That distinction is clear. But who then is really responsible for making sure a buyer understands a property's value from their perspective? Is it just up to the buyer to figure it out?
Oh, absolutely not. That responsibility falls squarely on the shoulders of the buyer's agent.
Okay. Why them specifically?
Because of their fiduciary duty. The buyer's agent has a direct professional duty to use their industry expertise, their market knowledge, everything they know, to provide their client with an honest, educated estimate of the market value of the property they're considering buying. This isn't just about opening doors. It's about active advocacy for the buyer's financial interests.
Can you give an example?
Sure. Let's say your buyer falls head over heels for a house listed at $700,000.
Yeah.
But you, as their agent, run the numbers. You do your CMA based on recent comparable sales, and it strongly suggests the market value is closer to $650,000.
Okay.
Your fiduciary duty requires you to advise your client against overpaying. You need to present the data, talk about the comps, guide them toward an offer that reflects the true market value, even if it means offering less than asking.
So you're protecting their investment.
Exactly. It's crucial. It prevents buyers from making emotional decisions and overpaying, ensures they're making informed financial choices. While the listing agent's job is to get the best price for their seller, the buyer's agent's job is to protect their buyer's financial well-being and help them acquire the property at a fair market price. It's a core part of their advocacy role.
Okay, that makes sense. Now, shifting to the loan itself, loan costs can be incredibly complex, and points, that term comes up all the time and seems to confuse borrowers. Can you clarify the fundamental difference between discount points and origination points? They both sound like extra fees, but they do different things, right?
Yes, they do very different things. Now, this is a classic area of misunderstanding, even for some new agents. Both are indeed fees paid at closing, and both are expressed as points, but they serve totally distinct functions that directly impact the overall cost of getting that loan.
Okay, let's start with discount points. What are those?
Discount points are essentially prepaid interest. You, the borrower, pay these points up front at closing with the specific goal of reducing the interest rate on your loan over its entire term.
So you pay more now to pay less later.
Exactly. It's a strategic choice. By paying more up front, you buy down your interest rate. This can lead to lower monthly payments and potentially significantly reduce the total amount of interest you pay over the life of a 15 or 30-year mortgage.
When would that make sense?
Well, for example, if you plan to stay in the home for a long time, paying discount points might be a really smart financial move. The long-term savings on interest could easily outweigh the upfront cost. You have to run the numbers, figure out the break-even point.
Okay, so discount points lower the rate. What about origination points?
Origination points are different. These are fees charged by the lender simply for the administrative costs of processing the loan application and creating the loan itself.
Like a service fee.
Pretty much. It covers the lender's overhead for things like underwriting the loan, preparing all the documents, maybe attorney fees for the closing, other administrative tasks involved in setting up the loan. It's a fee for the service of originating the loan. It does not reduce your interest rate. It's basically how the lender covers their operational costs and makes a profit on the loan processing part.
Okay, two different purposes, but they're both called points. Is there a connection in how they're calculated?
Yes, and this is the crucial shared characteristic and the mathematical relationship you absolutely need to remember for both types. 1 point always equals 1% of the loan principal. Always.
1 point equals 1% of the loan amount.
Correct. So if you're taking out a $400,000 loan, 1 point, whether it's a discount point to lower your rate or an origination point to cover lender fees, would cost you $4,000. Understanding this and the difference between the two types of points is really vital for borrowers. It lets them accurately compare loan offers from different lenders and assess the true cost of financing. You have to look beyond just the advertised interest rate to the total fees and the overall cost over the loan's term. An agent advising a buyer might help them weigh the pros and cons of paying discount points based on how long they plan to own the home.
Okay, the closing. That's the finish line, right? The exciting moment, keys change hands. But it's also absolutely packed with critical financial details, legal stuff, responsibilities. Let's try and break down some of the calculations and financial responsibilities that seem to cause the most confusion right at this pivotal stage.
Closing is definitely where it all comes together, or sometimes where things can unravel if you're not careful. All the financial pieces, the legal obligations, everything converges. First, maybe let's just define what closing truly means in the context of real estate here in California.
Okay. Is it just signing the papers?
Not quite. Closing, sometimes called settlement or escrow closing, is the precise moment when property ownership officially transfers from the seller to the buyer. And this isn't just about signing papers in an office somewhere. In California, it specifically happens when the deed is recorded at the county recorder's office.
The recording is the key.
The recording is the key. That's what makes the transfer public record. It legally establishes ownership for the buyer. Until that deed is officially recorded, even if all the other documents have been signed, the legal transfer of ownership hasn't actually happened yet.
Got it. Recording equals closing. Now, a term that sounds like a math headache but seems fundamental to closing costs, proration. What exactly is it? What kind of things typically get prorated? And maybe can we walk through how that process works with some, real-world numbers?
Yeah, proration definitely causes some head scratching, but it's actually quite logical once you understand its purpose. Proration is simply the act of dividing or allocating expenses, or sometimes income, like rent, between the buyer and seller, and it's based on their actual period of usage or ownership for that specific item or service.
So it's about fairness, making sure nobody pays for time they didn't own the property.
Exactly. It ensures fairness. So neither party pays for a period they didn't benefit from, nor misses out on income they might be due. It's all about accurately adjusting those costs, right down to the exact day of closing.
Okay, what kind of things get prorated?
Common items that are routinely prorated at closing include real estate taxes, because they're often paid semi-annually or annually.
Right.
Ongoing utility bills, maybe like water or sewer if they're not paid directly by the occupant and stay with the property.
Oh.
Homeowners Association, HOA, fees, those are typically paid monthly or annually, so they need to be split.
Oh.
And rents collected in advance by the seller.
Oh, okay. If there are tenants.
Yeah. If a property is sold with tenants and the seller collected rent for a month that goes beyond the closing date, the buyer is owed the portion of rent for the days they will actually own the property during that month.
Makes sense. What doesn't get prorated?
Crucially, what's not typically prorated are those one-time fees that are paid directly by one party at closing. Things like the appraisal fee, which the buyer usually pays for, or loan origination fees, or maybe attorney fees for document prep.
Because they're not ongoing expenses tied to usage over time.
Exactly. They're usually paid directly by the party incurring the cost, and they aren't ongoing expenses that need to be split between both parties based on who owned the property when.
Okay. Can we try and maybe property taxes?
Sure, let's walk through a couple of calculations, because this is where the theory meets reality.
Prorated property taxes buyer owns closing day. Okay, imagine this. The annual property tax bill for a home is $11,160. The sale closes on April 4th. And in this scenario, we'll say the buyer owns the property on the closing day itself. For simplicity, and because it's common in these calculations, we'll use a 360-day calendar, basically, assuming every month has 30 days.
Okay, 360-day year. Got it.
First, let's break down that annual tax into smaller bits.
$11,160 divided by 12 months equals $930 per month.
$11,160 divided by 360 days equals $31 per day.
Okay, $930 a month, $31 a day.
Right. Now think about who pays what. The buyer is going to be responsible for paying the entire annual tax bill of $11,160 when it comes due later in the year.
Right.
So the seller needs to credit the buyer at closing for the portion of the year that the seller owned and used the property, but for which the buyer will ultimately pay the tax bill.
Makes sense. So how much did the seller own it?
The seller owned it from January 1st up to, but not including, April 4th. So that's all of January, all of February, all of March. That's 3 full months, plus the first 3 days of April, April 1st, 2nd, 3rd.
Okay, 3 months and 3 days.
Right. So the seller's portion to credit the buyer is calculated like this. 3 months times $930 per month plus 3 days times $31 per day.
Okay.
That's $2,790 plus $93, which equals $2,883.
$2,883.
Yep. That $2,883 will show up as a credit to the buyer and a corresponding debit to the seller on the closing statement. It ensures fairness in who covers the tax costs for the year.
Okay, that makes sense. What about something the seller already paid, like HOA fees?
Good one. Let's do that.
Seller prepaid HOA buyer owes prorated amount. Okay, different scenario. A seller prepaid their annual HOA fees of $1,536 at the start of the year. The sale closes, and the buyer takes possession with exactly 5 months left in that HOA's fiscal year. Again, we use the 360-day calendar logic.
Okay, seller paid for the whole year up front.
Right. First, let's figure out the monthly HOA cost. $1,536 annual fee divided by 12 months equals $128 per month.
$128 a month.
Now, since the buyer is going to benefit from those prepaid HOA services for the remaining 5 months of the year.
The buyer needs to reimburse the seller for that time.
Exactly. The buyer owes the seller for those 5 months of benefit they're receiving. So the buyer's portion to credit back to the seller is 5 months times $128 per month.
Which is $640.
$640. Perfect. That $640 would be a credit to the seller and a debit to the buyer at closing. It adjusts the funds to reflect the buyer's usage of a service the seller already paid for.
Okay. These calculations really show how the final numbers get adjusted at closing. Precision matters.
Absolutely. They directly impact the final cash required or received by both parties. Getting prorations right is paramount for a smooth closing.
Okay, speaking of expenses that need handling at closing, what about existing liens on the property? Like if the seller still has a mortgage, or maybe there's an unpaid tax bill attached to the property, who's responsible for clearing those before the sale can actually close?
That's a critical question. Critical for ensuring the buyer gets clean title. And the answer is unequivocal. The seller is solely responsible for satisfying, meaning paying off any existing liens on the property before closing.
All liens, mortgages, taxes, everything.
Yes, existing mortgages, any judgment, liens from lawsuits, mechanics liens if a contractor wasn't paid, tax liens for unpaid property taxes or other government assessments, all of it. The whole goal is to deliver clear, marketable title to the buyer. Title that's free of any encumbrances that would cloud their ownership or worse, transfer with the property.
How does that usually happen? Does the seller pay them off beforehand?
Often it's handled right during the closing process to the escrow or closing agent. The seller typically authorizes the closing agent to use a portion of the buyer's purchase funds, or more commonly, the funds coming in from the buyer's lender, to pay off these existing debts directly to the lien holders.
Ah, so it happens as part of the closing fund distribution?
Exactly. It ensures everything gets paid off simultaneously as the title transfers, guaranteeing the buyer receives the property with a clean slate without inheriting the seller's old financial obligations. It's also worth noting, certain lends, especially property taxes, always have priority. They get paid first before other types of lends.
Good to know. Okay, let's dive into a few more common calculations. These seem essential for understanding mortgage payments and how lenders look at a borrower's financial picture. These are numbers every agent should probably be comfortable with, right?
Oh, absolutely. For anyone involved in real estate, especially if you're going to be an agent, understanding how lenders evaluate affordability and how loan payments are actually structured.
Yeah.
Yeah, it's fundamental to advising your clients effectively.
Okay, let's start with the payment-to-income ratio. What's that?
This is a key metric lenders use. It helps them assess a borrower's ability to comfortably handle their housing costs relative to their gross monthly income.
Okay. Can we use an example, like Jeremy from the study guide?
Sure. Jeremy's gross monthly income is $2,000. His lender uses a maximum payment-to-income ratio of 25%.
Okay.
To calculate his maximum allowable monthly housing payment, you just multiply his income by the ratio. Monthly payment equals school. Monthly income, payment-to-income ratio.
Yeah.
So $2,000 times 0.25 equals
$500.
$500, exactly. This ratio tells the lender that, based on their guidelines, Jeremy can comfortably allocate up to $500 of his gross monthly income towards his housing expenses, which usually includes principal, interest, taxes, and insurance PITI, without being considered overextended. It's quick check on capacity.
Got it. Now, what about understanding principal versus interest in the first payments of a typical mortgage? I hear most of the early payments go to interest.
That's generally true for amortized loans, yes.
Yeah.
Understanding this split is crucial because it shows how your payment is actually being allocated, especially in the early years. Let's use Jackie's scenario. She has a $300,000 amortized loan at a 5% annual interest rate. Her total monthly payment, principal and interest, is $1,800. The question is how much of her very first payment actually goes towards reducing her loan balance, the principal.
Okay, how do we figure that out?
First, calculate the annual interest owed. $300,000 loan amount times 0.05 annual interest rate equals $15,000 in interest per year.
Okay.
Then find the monthly interest portion. $15,000 divided by 12 months equals $1,250 per month just for interest.
$1,250 of the $1,800 payment is interest? Wow.
In that first month, yes. So finally, subtract that monthly interest from her total monthly payment to find the principal portion. $1,800 total payment minus $1,250 monthly interest equals $550.
Only $550 goes to principal in the first payment.
That's right. And this is the key insight for almost all standard amortized loans. A significantly larger chunk of your early payments goes towards paying off the interest. The amount going to principal starts small and gradually increases over the loan's term as the outstanding balance slowly shrinks. That's why it takes a while to build up significant equity just through payments at the beginning of a mortgage.
That really highlights how amortization works. Okay, one more big calculation. The full PITI payment. What does PITI stand for again?
PITI stands for Principal, Interest, Taxes, and Insurance. This represents the true, comprehensive monthly cost of homeownership for most borrowers, because lenders usually require you to pay property taxes and homeowners insurance along with your mortgage payment. They hold the T&I part in an escrow account and pay those bills for you when they come due.
Okay, so it's the mortgage payment plus escrow. How do we calculate that? Let's use Javier's example.
Okay, Javier is buying a home for $210,000. He's getting an 80% loan-to-value LTV conventional loan. It's a 30-year loan at 5% interest, and the lender gave him a mortgage factor of 5.37. Plus, his estimated annual property taxes and insurance together total $1,200.
Okay, lots of numbers there. Step one.
Step 1. Calculate the loan amount. Since it's an 80% LTV loan, the loan amount is 80% of the purchase price. $210,000 purchase price times 0.80 equals $168,000. That's his loan amount.
$168,000. Got it. Step two.
Step 2. Calculate monthly principal and interest, P&I. We use that mortgage factor the lender provided. The factor of 5.37 is usually given as the cost per $1,000 of loan amount. So first divide the loan amount by 1,000. $168,000 divided by 1,000 equals 168. Now multiply that by the mortgage factor. 168 times 5.37 equals $902.16. That's his monthly P&I.
$902.16 for principal and interest. Okay. Step three.
Step 3. Calculate monthly taxes and insurance, T&I. These are the escrow items. His annual total is $1,200. So we just divide that by 12 to get the monthly amount. $1,200 divided by 12 equals $100 per month for T&I.
$100 a month for taxes and insurance. Okay. Final step.
Step 4. Calculate total PITI. Just add the monthly P&I and the monthly T&I together. $902.16 plus $100 T&I equals $1,002.16.
$1,002.16.
That's Javier's estimated full PITI payment. That's the figure he'd realistically need to budget for each month, covering the major ongoing costs of owning that home. These calculations aren't just, academic exercises. They're the foundation for qualifying borrowers, understanding true affordability, and advising clients effectively in the real world.
That breaks down those numbers really well, turning potentially complex figures into manageable steps. Okay, shifting from the numbers slightly, accuracy and transparency seem absolutely paramount in real estate deals. Let's delve into why disclosing certain facts is so incredibly critical, and maybe touch on some specific forms and legal notices that help ensure everything is upfront and, clear.
Transparency is, it's really the bedrock of ethical and legal real estate practice. And the concept of material facts disclosure as well, it's an unwavering rule. There's no getting around it.
So why are material facts such a big deal? Why do they always have to be disclosed, even if the seller is trying to sell the property as is? Doesn't as is mean the buyer takes it, warts and all?
That's a great question. And a common misunderstanding about as is. The primary and fundamental reason we must disclose material facts is incredibly straightforward. If these facts were known by the other party, They could reasonably cause that buyer or seller to take a different course of action or maybe make a different decision regarding the property.
Like changing their offer price or maybe not buying at all.
Exactly. It's all about ensuring truly informed consent and preventing any kind of misrepresentation or, worse, fraud. A material fact is basically anything that could significantly influence a reasonable person's decision to buy, sell, or the price they'd be willing to pay.
Okay. But what about as is?
And as-is clause generally means the buyer accepts the property in its current visible condition without expecting the seller to make repairs to things they can see. However, and this is crucial, it never waives the seller's legal obligation to disclose known, hidden material defects or adverse facts about the property.
So even as is, they still have to tell you if they know the basement floods every spring.
Absolutely. If a seller knows the roof leaks severely or that the foundation has major cracks, but they don't disclose it even selling as is, they could absolutely be held liable for fraud or misrepresentation after the sale. And agents have duties here too. Agents have an independent duty to disclose material facts they are aware of or frankly should have discovered through a reasonably competent and diligent visual inspection of the property. It's all about providing complete, accurate information so everyone can make sound, fully informed decisions.
Got it. Disclosure is king, even with as is. Okay, what about proving ownership? What's the best evidence of title and what's the...
Right. In any real estate deal, understanding the quality and clarity of the property's title, the legal right to ownership is paramount. While there are various ways to research title, like an abstract of title reviewed by an attorney or certificate of title, in most places today, title insurance is widely considered the best evidence of title
Why title insurance?
because it provides actual financial protection. It insures the buyer, and usually the lender too, against financial loss caused by defects in the title that might pop up after closing. Things like undisclosed lands, errors in public records, maybe forged documents in the past, or claims from previously unknown heirs. It's essentially a guarantee of clear title backed by insurance coverage against unforeseen problems down the road. There are other systems like the Torrens system, but it's not common in California. Title insurance is the standard.
Okay, so title insurance protects against future claims. What about lis pendens? Sounds serious.
It is serious. Lis pendens is Latin, literally means suit pending. A lis pendens notice is a formal recorded legal document whose purpose is to inform the public, and especially any potential buyers or lenders, that a lawsuit is currently pending that affects that specific piece of property.
So it's a warning sign?
Exactly. It's recorded in the public records and acts as a big red flag, warning anyone interested in the property that its title might be affected by the outcome of that ongoing litigation. If you're a buyer and you discover a lis pendens notice on a property you're considering, well, you need to proceed with extreme caution and definitely get legal advice. It signals that legal disputes could seriously impact your ownership rights if you were to buy it.
Okay, definitely something to watch out for. Now, you mentioned lenders earlier. There are those specific forms, the loan estimate and the closing disclosure. They were supposed to simplify things for consumers, right? But sometimes they still seem to cause a bit of a scramble near closing. What's their main benefit, really? And why is the timing of delivering them so critically important?
You're referring to the forms introduced by the Consumer Financial Protection Bureau, CFPB, under the TRED rule, TILA RESPA Integrated Disclosure. And yes, their primary overarching benefit was absolutely intended to be simplification and transparency for consumers navigating the mortgage process.
Did they succeed?
Largely, yes. They replaced older, often confusing forms like the good faith estimate and the HUD-1 with a more standardized, clearer format. This makes it significantly easier for borrowers to understand all the costs involved, the loan terms, and importantly, to compare loan offers from different lenders, apples to apples. The goal was really to empower consumers to make informed choices.
Okay. And the timing, why is that so strict?
The timing is crucial and legally mandated for consumer protection. The loan estimate has to be provided to the borrower very early, within 3 business days of them submitting a loan application. This gives them an early, clear look at the estimated costs. Even more critically, the closing disclosure, which details the final loan terms and closing costs, must be received by the borrower at least 3 business days prior to the scheduled closing date.
The famous 3-day rule.
Exactly. That mandatory 3 business day waiting period is a cornerstone of the TRED rule. It gives borrowers dedicated, non-pressured time to thoroughly review all the final numbers, compare them carefully against their initial loan estimate, ask their lender or agent any questions, and make sure everything is as expected before they sit down to sign the final loan documents. Without proof the borrower received it 3 business days prior, the closing cannot legally proceed. It ensures borrowers aren't rushed into signing off on what is likely the biggest financial agreement of their lives.
That 3-day window seems really important for preventing last-minute surprises. Okay, one more definition before we move on. Voluntary alienation. Sounds technical. What is it?
It does sound technical, but the concept is pretty simple. Voluntary alienation just means the transfer of property title with the owner's full knowledge and consent. It's a willing, intentional act by the property owner to transfer their ownership.
Okay, like selling your house.
Exactly. The 2 primary ways voluntary alienation occurs are 1. Through a deed during a sale where the owner, the grantor, formally conveys their interest to a buyer, the grantee. 2. Through a will upon the owner's death, where the owner dictates how their property should be distributed to their chosen beneficiaries.
So selling it or willing it.
Those are the main methods of voluntary transfer. This is obviously in stark contrast to involuntary alienation, which happens without the owner's consent. Examples of that would be foreclosure by a lender, eminent domain seizure by the government, or losing property through adverse possession, squatters' rights, essentially. Understanding this basic distinction, voluntary versus involuntary transfer, is fundamental to grasping how property rights move from one party to another under different circumstances.
Okay, we've covered a lot about the core transaction process, but real estate is such a huge field, isn't it? It goes way beyond just selling single-family homes. What are some other key property types that maybe a new agent might encounter? And how do things like REITs, those investment vehicles, play a role in this broader landscape?
You're absolutely right. The real estate world is incredibly diverse, offering so many different avenues for professionals. Beyond residential, a really significant and, frankly, growing category is industrial real estate.
Industrial. Okay, what does that include? Factories?
It's a broad umbrella, yeah.
Yeah.
It encompasses properties specifically designed and suitable for things like manufacturing, but also, very importantly today, serving as crucial distribution facilities for goods or acting as large-scale warehouses for storage and logistics.
So like those giant Amazon fulfillment centers.
Exactly like those. Also, traditional manufacturing plants, light industrial spaces maybe for assembly or R&D, flex spaces that combine office and warehouse areas, cold storage facilities, the list goes on. These properties are typically characterized by large open floor plans, high ceilings, lots of loading docks, and often strategic proximity to major transportation infrastructure, highways, ports, rail lines.
Got it. So it's distinct from, say, retail or office space.
Absolutely. It's important to distinguish it. A vacation property, for example, or an office building or a shopping mall, none of those would be considered industrial real estate. This sector is really driven by factors like logistics efficiency, supply chain management, and the massive growth of e-commerce.
Fascinating. Okay, and you mentioned investment vehicles, REITs. I hear about those. They seem like a way to invest in real estate without actually buying a building yourself.
Precisely. REITs, or real estate investment trusts, have become incredibly popular. They allow individuals like you and me to invest in large-scale income-producing real estate portfolios or mortgages without having to deal with the hassles of direct ownership, management, or financing property yourself.
How do they work?
Well, they are companies that own or finance income-producing real estate across a range of property sectors. Most REITs trade on major stock exchanges, just like regular stocks, which offers investors liquidity. You can buy and sell shares easily. But what's the fundamental difference between the two main types? Equity REITs and mortgage REITs. They both sound like they invest in real estate somehow.
Yeah, what is the difference?
It's a great question, as they operate quite differently.
Okay.
The key distinction lies in what type of assets they primarily invest in and, consequently, how they generate most of their income. Equity REITs are companies that primarily own and operate income-producing physical properties themselves. Think of them as large publicly traded landlords.
So they own the buildings, malls, apartments.
Exactly. They generate the bulk of their revenue through collecting rents from their diverse portfolios, which can include shopping centers, office buildings, apartment complexes, self-storage facilities, data centers, hotels, even things like timberlands or cell towers. Their business model is directly tied to the performance and appreciation of those physical real estate assets.
Okay. So what do mortgage REITs do?
Mortgage REITs, sometimes called M-REITs, operate differently. They generally do not own physical properties. Instead, they primarily invest in mortgages and mortgage-backed securities, MBSs.
So they're investing in the debt, not the bricks and mortar.
Precisely. They essentially operate on the financing side of real estate. They earn income primarily from the interest generated by these mortgage investments. They might originate mortgages or, more commonly, buy existing mortgages or MBSs on the secondary market. They act more like a bank or a specialized finance company, lending money for real estate or investing in the debt secured by real estate. Their profits often come from the spread between the interest they earn on their mortgage assets and the cost of funding those investments.
So the big difference is physical property versus loans secured by property.
That's the core distinction. It's not about how they acquire assets, cash versus leverage, though that matters too, but fundamentally what assets they hold. Equity REITs hold property, mortgage REITs hold debt. An investor looking for exposure to property appreciation and rental income might lean towards equity REITs. Someone seeking potentially higher yields from interest rate spreads, perhaps with different risks, might look at mortgage REITs.
That clears up that confusion perfectly.
Hmm.
Okay, thinking about shared ownership again, beyond just co-owning a house, we also have structures like condominiums and co-ops. They have their own unique features, especially when it comes to shared spaces, those common elements. Can you elaborate on what those are and then maybe talk about co-op boards? They have a reputation for being quite selective. What are the key reasons they can't reject an applicant versus what they can? This seems like a really important area for fair housing.
Absolutely. In shared ownership communities like condominiums and co-ops, you definitely have what are legally defined as common elements. These are essentially all the portions of the overall property that are not part of the individually owned units or apartments, but instead are collectively owned and shared by all the unit owners or co-op shareholders.
Like hallways and the swimming pool?
Exactly. Think of them as the shared infrastructure and amenities that make the community function and hopefully enhance its value. Classic examples include the land itself, the building's foundation, the roof, the exterior walls, shared recreational facilities, pools, fitness centers, maybe tennis courts, common hallways, lobbies, elevators, stairwells, laundry rooms, community rooms, sometimes shared parking areas or garages, and the underlying mechanical systems, heating, plumbing, electrical conduits that serve multiple units.
Okay.
Understanding what constitutes common elements versus what's part of your individual unit is really crucial for residents, buyers, and property managers. It dictates who's responsible for maintenance, repairs, insurance, and how the association or co-op fees are allocated.
Right. Now, about those co-op boards and their applicant rejection criteria, cooperatives or co-ops are pretty unique, aren't they?
They really are, because when you buy into a co-op, you're not actually buying real property in the same way you buy a condo. You're buying shares in a corporation that owns the entire building.
Shares. Okay.
And those shares come with a proprietary lease, which gives you the right to occupy a specific apartment unit. This corporate structure gives the co-op's board of directors significant power over who can purchase shares and therefore live in the building. They conduct interviews, review financials. They can indeed be quite selective.
But their power isn't absolute, right? Especially regarding fair housing.
Absolutely not absolute. Their power is strictly limited by federal, state, and sometimes local fair housing laws. Co-op boards cannot legally reject applicants based on their membership in a protected class under the Federal Fair Housing Act.
What are those protected classes again?
The Federal Act prohibits discrimination based on race, color, religion, sex, which courts have interpreted to include gender identity and sexual orientation, national origin, disability, both physical and mental, and familial status, meaning having children under 18.
So they can't turn you down just because of your race or because you have kids or a disability?
Correct. Rejecting someone for any of those reasons would be illegal discrimination and could lead to severe legal penalties, lawsuits, and fines. The core principle is ensuring equal access to housing opportunities for everyone.
Okay. But they can reject people for other reasons. What kinds of reasons are generally considered acceptable?
Yes, they can reject applicants for legitimate, non-discriminatory, usually business-related reasons, as long as those standards are applied consistently to all applicants. Acceptable reasons often include things like not meeting minimum income requirements. Co-ops need to ensure residents can afford the monthly maintenance fees, lacking sufficient cash reserves post-closing. Many co-ops require buyers to show they have a certain amount of liquid assets left over after buying the shares. Having a poor credit history or history of financial instability This indicates a potential risk to the co-op's overall financial health, a history of evictions or disruptive behavior in previous residences. Failing to comply with specific reasonable building rules, such as strict policies on pets, number, size, breed, or maybe rules about subletting or renovations, or even simply failing to provide complete or accurate information during the extensive application and interview process.
So financial stability and ability to follow rules are okay reasons, but protected characteristics are absolutely off limits.
Exactly. It highlights that careful, sometimes difficult balance between a co-op's right to maintain its community standards and financial stability and its legal obligation to adhere strictly to fair housing laws. It's a legal tightrope they have to walk very carefully.
That's a really comprehensive breakdown. It clarifies the boundaries nicely. Okay, finally, let's bring it back to those of you listening who are maybe on your pre-licensing journey or just starting out. What's a strategic move you can make that can really give you an edge in your career once you are licensed? It's such a big field. Like we said, where do you even start to build real expertise?
That's an excellent question, and it's something I think every new licensee should seriously consider right from the beginning. While getting that broad real estate license allows you to legally work across various property types and transaction types, one of the most significant strategic moves a new licensee can make early on is to consciously embrace specialization.
Specialization, meaning like picking a niche.
Exactly. Instead of trying to be a jack of all trades right out of the gate, juggling residential sales, maybe some commercial leases, a bit of property management, trying to handle investment properties, luxury homes, industrial sites, which is overwhelming and frankly difficult to do well.
Yeah.
Committing to a specific real estate specialization allows a license holder to much more easily gain and maintain deep competency and expertise in their chosen area.
What are the benefits of doing that?
Oh, there are several key benefits. First, deep market insight. You become truly familiar with a specific segment, its trends, its unique valuation methods, its specific challenges the key players involved. Second, enhanced competence. You develop a profound understanding of the nuances, the legalities, the best practices within that niche. This naturally leads to greater efficiency and, importantly, fewer mistakes. Third, stronger client relationships. Clients are naturally drawn to experts. Your specialized knowledge lets you genuinely understand and solve their specific problems, which builds incredible trust and loyalty. People want the expert for their situation. Fourth, targeted marketing. It makes your marketing efforts way more effective and less costly. Instead of trying to appeal broadly to everyone, you can precisely target your ideal clients and position yourself as the go-to expert in your niche. And fifth, maybe resilience. Different specializations often perform differently depending on the overall market conditions. Having deep expertise in one area can sometimes provide more stability than being spread too thin.
So specializing helps you become a true expert, which builds credibility and attracts the right clients.
Exactly. Ultimately, this enhanced expertise translates into providing genuinely superior service, achieving greater success for your clients and yourself, and truly excelling in your chosen field within the vast world of real estate. It's about building depth and credibility, which naturally attracts business, and I think leads to a more fulfilling and successful long-term career. It's about finding your corner of the real estate world and really mastering it. Hashtag outro.
Wow, expert speaker, this has really been an incredibly focused and I think really insightful deep dive. We've definitely peeled back the layers on some truly essential concepts, things that, as you've highlighted, often are sources of confusion, not just for students studying for the exam, but even for practitioners out in the field. Directly addressing those specific points that can be stumbling blocks, like the nitty-gritty of agency types, or how proration actually works, or breaking down those loan calculations. I think that makes such a difference.
I hope so.
And remember, everyone listening, this session was really designed to be your personalized study guide. We aim to directly address those areas where a clearer understanding can make all the difference, whether that's boosting your score on the exam or making you a more confident and competent professional in your future career.
Absolutely. Because true mastery in real estate, it isn't just about memorizing definitions or, getting a multiple choice question right. It's really about grasping the underlying principles, truly understanding the why, and then being able to apply that knowledge effectively in practical real-world situations you'll actually face.
Yeah.
Every question you might have gotten wrong on a practice test, don't think of it as a failure. Think of it as a signpost. It's just guiding you to an area where a deeper level of understanding is waiting for you to uncover it.
That's a great way to look at it.
So my final thought for you is this. Don't just learn the answers you need for the test. Learn to constantly ask why. Why is an appraisal considered more reliable than a CMA? Why is a gratuitous agency still a potential liability for the sponsoring broker? Why are material facts absolutely non-negotiable even in an as-is sale? Why do people choose joint tenancy over tenancy in common? And what are the real, tangible legal consequences of that choice?
The why is where the real learning happens.
Exactly. The why is where true knowledge lives. That's what allows you to adapt, to problem solve, and ultimately to excel in any real estate scenario you might encounter down the road. So keep dissecting those concepts, keep asking those why questions, and keep diving deep into the material. You've definitely got this.